Hello, how are you doing? All good? Hi guys, good afternoon. So welcome to the SBR experts revision class. So that's what we are here for. And what all that we are going to start off with is, okay, so this was study plan I had created from 1st of February. Okay. But today we are at 16th of February. So study planner is gone. But why I want to show this to you all is now because there were, certain last week we had an issue, the week before we had an issue, so we were not able to conduct the experts exam sessions or revision series. So what we can do now with this is just look at the areas that are important, that you need to be in a position to, tackle and understand it well in depth. That's important. And you should be in a position to know the standard in and out, right? So that's why I've given the weightage of based on the importance for the upcoming exam. All right. Okay, so when it comes to SBR, there are a couple of standards, or a lot more standards that we are discussing here, and a couple of more than what we discuss in FR level, right? So what are the standards that are covered here? We have IAS 1. So now at this point, you need to know how IFRS 18, like what is IFRS 18 and what are the components. That's it. Knowing it is enough, right? How IFRS 18 changes IAS 1 requirements, all right? Then you have IAS 2, negligible standard, IAS 7, again, not very important for individual, but group accounting is where this plays an important role here. IAS 8, you need to know how to apply this in terms of changing of policy. So this would be required to sometimes tackle ethical questions. Then events after reporting period, again, a very small standard, negligible. We have income taxes, property, plant, equipment. This is a new area, employee benefits. And the past paper that we are going to discuss, which is September, December 24. And this past paper also, they've touched upon IAS 19. So we'll be discussing that. Then IAS 20, a small standard. Then IAS 21, again, you need to know this in terms of consolidation or group accounting, all right? Then you have borrowing costs, IAS 23. Then you have related party, again, a new standard that's being tested here. IAS 27, separate financial statements, that's something that we have touched upon in FR in the last couple of sessions. But if you have if you are doing SBR after a while, then this is a new standard for you because FR did not have this standard in the past. They've recently introduced it. Then IAS 28, a new standard again, goes in depth. So in FR level, we would have touched upon associates. So here we are going to look at joint ventures as well. I mean, we have looked at already. Then IAS 32 is important, very important, part of financial instruments. So this is a financial instrument standard. Then you have IFRS 7, IFRS 9. You need to know these in and out. A very important standard. Earnings per share, knowing it is good. This will be required when you are analyzing a financial statement, but not very important. Interim financial reporting, knowing the standard is enough. Impairment of assets is a very important standard again. Provision contain liabilities, a standard. Some of the nuances of standards are important here. Intangible assets, investment property, and IAS 16. These three standards you should be able to contrast and compare. Okay, IAS 16, IAS 40, and IAS 38. Okay. Then IAS 41 negligible. IFRS 1 is going to go out of the syllabus soon. IFRS 2 share-based payment is a new standard, but a small standard. It's not a big standard, but there are some technical understanding you need to have, a standard understanding in depth, right? Now IFRS 3, we've seen it in FR, but here we're seeing it in a deeper level. IFRS 5, another small standard, but there are some nuances that you need to know here. IFRS 8, again, you need to know the criteria, right? What are the criteria, the 10% versus the 75% criteria, that's important. Then these are all the IFRS 8, IFRS 10, IFRS 12. These are related to group accounting, right? You need to know that as well. Then we have IFRS 13, small but a very important standard. This is where this is a standard you'll be using to arrive at fair values. All right. Then IFRS 15, again, a very important standard. And there are nuances, new areas that you need to be really particular about and really understood in depth. IFRS 16, again, a very important standard that we have here. Then we have IFRS for SMEs. This is new. Practice statement 1 new, practice statement 2 new, S1 new, S2 new. These are new standards in SBR. Conceptual framework we've seen, but here we see it at a more deeper level in a position to compare with other standards and the contradictory areas in the standards that go against conceptual framework requirements. So you need to be in a position to understand that. And then the integrated reporting framework, the International Integrated Reporting Framework. So IR is integrated reporting, right? So these are all part of analysis. All right. So the technical articles. So these are technical articles that are there in SBR, but now reading everything is going to be difficult. So better you all touch upon some important technical articles. For example, their financial instruments, you need to know that. Just read about it. Deferred tax, if you know that very well, you don't need to read that. IFRS 2, read that technical article. IFRS for SME, small style article, reading, if you have time, read that. All right. This is important. You need to understand how OCI works and what are the issues with OCI. All right. Then we have impairment of financial assets. That's important technical article. Revenue revisited. If you are good with revenue, you don't need to read that either. This talks about compound instruments. So it's good to read, right? Just read that. Cryptocurrencies. This is a current issue, but knowing it is good enough. You don't need to remember every element there, but knowing how it works is good enough. So read that technical article. Additional performance, APM, this is very important. Then using business model, this is also going to help you with analysis. Then sustainability disclosure standards is also very important. Read that, right? Crowdfunding, I would say, is something that you need to read and know the impairment of financial assets component. Asset ceiling, initial coin offering, non-GAAP, etc. That also is important. So here also there is implication of a global pandemic or natural disaster. Now that is outdated. Global pandemic is outdated. So it's very unlikely that they will ask questions around around global pandemic or natural disaster, but they may ask you how this is going to impact it in the other current issues, for example, climate changes. So that they have given some detailed insights in these two technical articles. Read them. Right. Then this is very important. Onerous lease contracts and impairments and invest issues. So these are technical articles you can read. That's good. Okay. So at this point, you don't have time to read everything. All right. Okay, so just to quickly take you through SBR exam format, I'm sure you should be knowing how the format works, but let me quickly take you through how the format works. So section A, section B, there are two sections. So section A is 50 marks, section B is 50 marks. Section A has two questions, question 1, question 2. Question 1 is of 30 marks, question 2 is of 20 marks. So question 1 will be requiring you to correct some consolidation issues, right? They will be giving you a pre-populated spreadsheet that you have to correct by using plus or minus, and you should be very careful about plus or minus signs when you're using pre-populated spreadsheet. All right. So it requires correcting spreadsheet for issues, which would be around 10 to 14 marks, and you will discuss or explain these corrections as well. Okay, that's what this question is going to revolve around. Group financial statement extracts. Okay, or they can come up with any financial reporting issues. So you need to know standards and how they impact group accounting. All right. Then question number 2 is going to focus on, now that's going to be of 20 marks, and that's going to focus on ethical implications, right? So reporting and ethical implication. Reporting meaning any IFRS related issues. Ethical implication meaning any ethics related issues, right? Code of conduct being breached. Right? Then this includes 2 professional marks, easy marks that you can gain. So you don't have to work separately for these 2 marks. As you work with the question, as you bring in more clarity in your answer, more structure, you will get that 2 professional marks. So you should be in a position to collect the easy marks by answering the questions, because there's no separate effort needed there. Section B, 2 scenario-based questions. This could have discursive and computational elements, and it can cover any syllabus area, right? So one question would focus on analysis, right? One question would focus on analysis, and this again is going to include 2 professional marks. Now, professional marks, again, as I told you, will not require separate, it won't require separate efforts. Rather, as you are answering the question, when you bring in clarity, when you bring in structure, you are going to gather those marks. All right. So these are the exams that you have in your practice platform, right? So you should be in a position to do all these exams. We're discussing question 1 and 2 of this paper. So you should attempt 1, 2, 3, 4, 5, 6, 7, 8, 8 past papers, 2 sample exams, right? Then there are 3 practice exams and 2 specimen exams. So 8 there and 7 here, right? 7 additional papers. Plus one most important paper that has been released is sorry, pre-March mock. So that makes it the 8th additional. So you have 16 papers that you can work with. All right. So study plan, let me just take you from day 16 to onwards what you're supposed to do, because today is day 16. So what you're supposed to do here, right? So here I had asked you all to do practice questions until day 21, which is around 20th of this month. But you all can directly get into past papers, right? This section is what you need to focus on at this point. Right? So you do 3 past papers every day, and you read relevant examiner reports. Then whatever standards are tested in those 3 past papers, you revise those standards, right? You get the in-depth understanding of those standards. That's very, very important, okay? So that's the format you'll be following for the day 22. I mean, you can apply it from today, which is day 16. So let's change this a little bit. Day 16, day 17, right? Then pre-March mock under exam conditions. If you feel that it is too early, right? If day 18 is too early for pre-March mock under exam conditions, you can push this below, right? You push this below, right? So day 18, again, you focus on this, right? 3 past papers, relevant examiner reports, and revision of standards. So that makes it 9 past papers, but we have 8 past papers. If you get hold of 1 more past paper, that is good enough. But if you have access to one more pre-mock, for example, if you have a December pre-mock access, do that. All right. Then day 19, you focus on specimen papers, right? And day 20, now here there are no more past papers, so rather you can focus on sample papers and the practice exams, right? Practice. Right? Practice exams. Then day 20 is that. So that is day 20. So day 21, you can attempt your pre-mock. You attempt your pre-March mocks on the exam condition. Day 21, I'm sure you should be in a position to. Again, after attempting that, revise the standards. Now, day 22, 23, 24 spend on revising theories, reading technical articles, reading examiner articles, and watching topic explainer videos, right? So that's for the 3 days. Then use practice questions. If you have access to Kaplan revision kit, practice questions from that, right? You do wider reading, you revise standards, you do technical articles, right? Read technical articles. And then you can even go for another round of past papers, right? The papers that you felt were really important that you want to do again under exam conditions, spend time on those past papers, right? So that's the format that you should be following at this point, right? Not this entire study planner. But the study plan I'm sure taking you through is to take you through the specific areas and standards you should be knowing, okay? So IAS 16, 40, 38, 23, 20, 36, and IFRS 5. These are known, you call them non-current asset standards. And this is examiner's favorite area, right? Not just this, there are more favorite areas that we'll be looking at shortly, right? So you should be in a position to compare and contrast IAS 16 and IAS 40 as well as IAS 38, right? So mainly in IAS 16, IAS 40, you should be in a position to compare and contrast a revaluation and fair value model, right? Then how disposal of PPE works, you need to be very clear about that. You should focus on dismantling costs and how that impacts non-current asset and provision liability, both, and how you depreciate, how you unwind. So that's what the financing component unwinding cost is. So remember, any place where you have a significant amount of time between the transaction and the settlement, you always bring the financing component. When there is, it goes beyond 12 months, you always have to bring the discounting factor in. And then you need to unwind until the settlement happens. All right. Then IAS 38, you should be in a position to clearly designate the purchased versus internally generated intangible assets, including goodwill, right? What is purchased, what is internally generated, why purchased you can recognize, and why internally generated you can't recognize. You should be knowing that. Then criteria of capitalizing development cost, which is a high rate, right? You should be knowing that. And how internally generated intangible asset, now this is important, how internally generated intangible asset of a company may become a purchased intangible asset in terms of group accounts. Why? Because group accounting, someone who is purchasing you, now if your company is being sold, for you, your intangible assets are internally generated. But if someone else is purchasing you, for them that becomes purchased intangible asset. So now the rules change, right? So you need to remember that. Okay. Right. And then how fair value adjustment is necessary, right? When the group account comes in, that's also very important. All right. So here I've given some reference technical articles. You don't need to exactly read that at this point. Just read the important technical articles I showed you. IAS 23, you should focus on weighted average interest rate. Understand when to commence or start, when to pause or hold, cease, you call it in other terms. And so when to commence, when to hold, when to cease, right? When to stop capitalizing. Okay. Right. The IAS 20 critically evaluate the impact of conditions failing to be met. Now we know when the conditions are met, what we do. You know, we have revenue grant, we have capital grant, we use a deferred income method, but capital grant, we can even use a depreciation method. So when the conditions meet, we recognize that, right, as revenue. Otherwise, if the conditions do not meet, what happens? That you should be focusing on. That is very important here, right? And how the repayment element is going to work. If you are to repay, what happens? An interest-free or below market interest rate loan from government and the impact on grant, you should know. What happens when the government gives a loan that's at the below market rate, right? Then the grant versus assistance, right? What is grant? What is assistance? You need to know that. Then there is IAS 36. So you need to focus on indicators of impairment, right? And then you should focus on how you need to impair when indicators are present and when you'll be impairing or when you'll be doing an annual impairment test. When you do test when the indicators are present and when you do annual impairment test, you should be knowing that. And then what is the impairment reversal cap in terms of individual assets, in terms of CGUs? Caps is different in both of those. So what are they, right? And how you cannot reverse the impairment loss in full. And how the additional would go as revaluation if you are holding the asset under revaluation model, which is IAS 16. Then VIU calculation, value in use calculation, how you do cash flow projection, what are the criteria to do cash flow projection important. CGU, what is CGU, what does not necessitate for it to become a CGU. Then corporate assets or allocated assets, how you are going to allocate that, how you are going to allocate the goodwill, right? So all those you need to remember. In IFRS 5, so disposal group versus HFS versus DO. Now DO, held for sale and discontinued operation, we've seen at FR level also. So here disposal group is important. You need to know what that is. Then focus on recognition and presentation. Conditions to be met for classification as IFRS, right? And how after classification you will not depreciate. You need to remember. Now, these are nuances in the standard that you need to remember. All right. Then changes to a plan of sale, right? Reinstating at the lower of carrying amount minus depreciation, right? Had it not been reclassified. Now, what happens here? Okay. FR level, we have reclassified, right? We have classified as held for sale. Now, here you need to focus on what happens if the sale does not happen. What if the conditions change, right? So you have to reclassify it as non-current assets. So what happens then? How are you going to deal with it, right? That also you should know. Okay. Then presentation of assets and liabilities separately. Recoverable amount, you need to know what that is. Then announcement after the reporting period, if IFRS 5 asset is being held for sale or announcement happens after the reporting period, it's a non-adjusting event. So these are things that you need to remember here. This is a highly important area. All right. Then there is IFRS 16, which is again a very, very important standard. IFRS 15, very important standard, and IAS 12. Again, these are highly important, examiner's favorite. Because you see these standards repeating in almost all the exams, right? Any question, they can bring these, right? So what you need to remember here, IFRS 15, you need to focus on key elements of 5-step model application. You should be knowing what's principal versus agent. Go ahead and clarify, understand that. And the performance obligation revenue component, how commission versus full revenue works here. Then variable consideration, when it comes to the consideration, right, determining the transaction price, how the variable consideration affects, how the financing component affects, how the consideration payable affects when determining transaction price. So you need to know how to deal with financing component there, how to deal with variable consideration. And you should also consider how discount would be applied when looking at allocation of transaction price, right? When there is a transaction price and when there's a discount, how are you going to allocate that discount? Whether it's going to be specific to certain performance obligations or you are going to apply discount across all the performance obligations. That's something you need to understand and know, right? And satisfaction of performance obligation, whether it's happening at a point in time or over time, to recognize appropriate components of revenue, right? Then there could be instances where contract modifications may happen. So you need to understand how contract modification works, right? When you'll be considering it as a separate contract, when you'll be considering it as a part of the contract, where the distinct goods play an important role. When separate contract, how are you going to deal with that, right? Whether is it going to be completely, you seize a contract or you shut the contract down, you create another contract, or you create two contracts together. So that's something that you need to understand. All right. Then understand specific transactions. You need to know what consignment inventory, repurchase agreement, very important, put, call, forward. Then bill and hold arrangements. You need to know that warranties, customer options for additional goods and services, customers' unexercised rights, or you call it breakage, non-refundable upfront fees, and licensing. Licensing with the right, with the access or right to use. How does that work? You need to know that. Sales with the right of return and crowdfunding element affecting IFRS 15. You read the technical article. Right? That's where you understand how crowdfunding affects the IFRS 15. Then revenue recognition principle for contracts over time. When outcome is profit, loss, or unknown, the 4-step approach. So there are 5-step model and 4-step model that you need to know. Then how cost of obtaining versus fulfilling a contract works. And how, in terms of onerous contract, cost of fulfilling versus cost of terminating works. Cost of fulfilling a contract versus cost of terminating. Right? That you need to remember. Then you also need to look at sale and leaseback and how there's an IFRS 16 connection there. So onerous contract, there's IAS 37 connection. So all these standards are interconnected, interlinked. So you need to be able to understand how they are linked and how the linking works. All right. Then IFRS 16, you should be focusing on ROU asset. Right? FR level, what you did, you were given the values. You just had to capitalize. You just had to depreciate. You just had to record the lease liability with very minimal calculation. And then you use amortized cost for subsequent measurement. But here it's different. Here you need to focus on ROU asset, the initial recognition calculation, what becomes your non-current asset. It's going to be the present value of which becomes a lease liability, the initial measurement there, and then whatever amount you paid in advance, right? And then the lease liability, how there can be separating components, what happens when the reassessment happens, right? So where there could be lease component, non-lease, so how you separate those. Then lease term, so you need to be very particular about the options where you have options to extend the lease or the options to terminate, which is whatever is probable to happen. So how that would also change the lease term, right? Then interest expense versus interest payment. Interest payment, you need to know how arrears payment in arrears works, how payments in advance works. Arrears at the end of the year, advance at the beginning of the year, how the interest calculation works after deducting the interest paid in arrears, and how interest paid in advance. And if it's in arrears, how you calculate interest on the opening liability, then you calculate the payment, right? So you need to know that nuance here. Then you need to also understand the depreciation of ROU, what's going to be the period to use, right? The lease term again, versus change in lease liability, right? Subsequent measurement. You will use amortized costs and how you're going to split that between current liability and non-current liability, right? That also you should know, both in the context of a payment in arrears and payment in advance, all right? Then sale and leaseback, again, the connection of IFRS 15 comes here as well, and how this is connected to IFRS 15 and how to account for ROU asset and lease liability in the context of sales and leaseback alongside profit on disposal. So the key tip here is you need to remember the formula. There is a formula, remember that. If you do not remember, go and revise. Then comes lessor accounting, where you need to understand what is finance versus operating lease, what is sublease, right? So you should understand those in detail. And IAS 12 taxation. So here you need to understand the concepts of deferred tax liabilities and assets very clearly, right? What is deferred tax liability? What is deferred tax asset and how they work, right? And in specific situations, how revaluations impacts the change, the difference, temporary difference, share option schemes, how that affects temporary difference, leases, how that affects unused tax losses, how that affects in terms of specific situations. Then in terms of business combination, how fair value adjustment, PURP, unremitted earnings is going to bring the temporary difference and how you are going to deal with taxation or deferred tax in that case, right? Current versus deferred, and how you are going to deal with these in these specific conditions, right? Again, a very important set of standards. Then there's financial instruments, again, a very, now this is one of the most complicated standards, but examiner's favorite. Why? They like the standard and they like the students. They would appreciate if students also know what the standard is, right? So here you need to understand how financial instrument is split into financial asset, financial liability. Then there's equity component also, right? Financial asset, how it can be either investment in equity or debt instrument, right? Then the subsequent measurement, initial measurement is anyway, it is going to be the fair value transaction not capitalized unless it is subsequently held through fair value through profit or loss. Any other cases, it is going to be capitalized. Now, equity, how you will be dealing with fair value OCI and how fair value through profit or loss. These two are the subsequent measurement. Debt, 3, amortized cost, fair value OCI, fair value PL, and how these depend on business model test and contractual cash flow test. You need to know what is business model test, what is contractual cash flow test, how long-term, short-term, mid-term works, and how cash flow being other than principal interest works here, right? Then comes the financial liability. Subsequently, you measure it most of the time using the amortized cost, but sometimes you can use fair value through P&L. It is rare. FEPL is rare, right? So how you deal with that? Okay. Now this is one component of financial instrument. Then there is compound instruments, which you have to split between liability and equity, right? So that's your compound instruments. And apart from that, you also have new areas here, which is derivatives. And there is hedge accounting. So here you need to know what is hedging instrument and what is hedged item versus hedged instrument, right? So that is your financial instruments in a summary. So here you are supposed to focus on understanding why amortized cost table is used. If you do not know, if you can't explain why amortized cost table is used as subsequent measurement, you need to really look at that as well, right? Recognition and derecognition criteria for both financial assets and financial liability, right? How you recognize, how you derecognize, and how you deal with subsequent measurement, all right? So subsequently, you mostly use FVPL for financial liability when it's held for trading, short term, or to avoid accounting mismatch, right? Those are the two elements where you'll be using this. Accounting mismatch meaning, now let's say IAS 40 investment property, to go build that, you've taken a loan, right? To loan, you purchase that. So when whatever you've purchased, right, falls in IAS 40, there the gains or losses on fair value adjustment comes into profit or loss. And in that case, you are supposed to use FVPL for that loan also, where you'll be recording the changes in the P&L. Okay, that's the mismatch adjustment. Compound instruments, subsequent measurement using AMC, how equity remains the same throughout because stand is silent there. And when converting at the end of term, how you are going to split that converted equity element between share capital and share premium, and how you are going to derecognize liability. So those are the important elements you need to know when you are at the end of the period transforming, or let's say you are going to convert it into an equity. All right. And then you need to understand effective rate versus nominal rate or coupon rate, right? Effective rate, when you use effective rate, which is a market rate, when you use nominal rate, which is a coupon rate, at the payment level, at the interest cost level, right? Then comes financial assets, as we looked at, equity instruments versus investment in debt instruments, right? Again, why amortized cost table is used is very, very important. Why it's used in, amortized cost and FVOCA, and what happens when you do not use amortized cost table. Why there is no amortized cost table in equity, right? To understand that. Then subsequent measurement, we just looked at that. And why will FVOCA will be reclassified to FVPL when disposed in terms of debt instruments, but not in equity instrument. Now, equity instrument, you cannot reclassify, but debt you can reclassify. Why? Understand those whys. That's very important. Transaction cost, capitalization versus expensing. How you will be capitalizing transaction cost, when you will be expensing the transaction cost. Very important. And then the ECL model, right? Expected credit loss model. 12 months credit loss versus lifetime. When you use 12 months, when you use lifetime, and how provision matrix works. Very important for financial assets. And then modification of debt, right? So purchase credit impaired, also something that you need to look at, and reversals of impairment, also something that you need to remember, right? In terms of impairment, ECL model. When you purchase credit impaired asset, how does that work? And reversing the impairment, how does that work? Then modification of debt. How, when you modify debt, what happens then? You need to know that. Derivatives such as forwards, futures, swaps, options, hedge accounting, where you need to know whether it's fair value or cash flow hedge. How hedge effectiveness is dependent on hedged instrument and hedged item, right? Then when you are replacing or discounting hedge accounting, what happens then, right? Content is heavy, but you need to know every aspect of this content, so that now, but I've captured all the important nuances here. So if you're able to refer that, brilliant. Right. Then comes conceptual framework and IFRS practice statements. Again, very important. Knowing conceptual framework is very important. One, because it's a critical element of the IFRS reporting. Two, in case you're not able to recall what's the IFRS standard, you can always refer to conceptual frameworks requirement to answer your question. Okay, that flexibility is given at SBR level. So conceptual framework, you need to be thorough with the entire conceptual framework of 2018 and the application, and try to evaluate its relevance to all the standards. And in case you forget, you don't understand what standard it is, then you go back to conceptual framework and refer the conceptual framework requirements. All right. Whenever there are no standards for certain items, you need to fit it into certain standards. How do you? Then you refer the conceptual framework. Okay. That's why it's very important. Right. Then IFRS versus contractual, conceptual framework, how the standard wins whenever there is a contradiction. If IFRS says something else, conceptual framework says something else, so it's IFRS that takes precedence, right? Okay. Then OCA criticism, you need to understand, and you need to be able to criticize OCA as well. Okay. Practice statements. This is practice statement 2, which is materiality. So 4 steps. What are the 4 steps to do a materiality judgment? Then what is quantitative versus qualitative, right? Factors of materiality. Then practice statement 1, which is management commentary. The nature of the business, management objectives and strategies, entities, resources, risks and relationships, key performance measures. So these are the main elements of IFRS practice statement 1. Okay. Right, now, why am I giving now? This was a study plan where I wanted you all to spend each day to focus on this, but now you don't have each day. So you refer this, whatever you feel, okay, I'm not understanding that, quickly go and refer those areas and those standards, okay? Then this is a mid-important area, IAS 37, IAS 10, IFRS 13, IAS 8. But knowing that is important though. It's not low, it's mid, right? So IAS 37, you focus on onerous contracts and how IFRS 15 connection comes there. How provisions you use present value, what's the criteria, when do you unwind the discount, and how it impacts the liability, and what happens when there are restructuring provisions, what you record, what you don't. And in terms of group accounting, how the requirement of recognizing contingent liability as a fair value adjustment becomes important. Again, group accounting level. If there's a contingent liability at my company level, I disclose it. But group require, when you are when someone else is acquiring a business, they will have to recognize that contingent liability at a fair value. Okay. Right. Then onerous was restructuring and dismantling provisions. So all those are important provisions you need to understand. And IAS 10 focus on how to evaluate whether evidence was present or not at the reporting date to decide whether adjusting or non-adjusting event. Now, for example, why IFRS 15 announcement after the reporting date is a non-adjusting event. Try to understand. Like that, try to see what else could be non-adjusting. Now we know, okay, where the bad debts isn't adjusting, the fire is not adjusting, but that's not what you require here. Here, they may ask you questions that you might have never thought about, but there you have to decide whether it's adjusting or not adjusting. So how would you decide that? Only if you understand the logic behind identifying adjusting and non adjusting event, right? Then IAS 8 focus on when and how retrospective requirement for change in policy can be ignored, right? Policy change usually supposed to be retrospective, but when it can be ignored, right, based on standard requirements. For example, IAS 16 allows to use prospective treatment, meaning current and the future years, retrospective past years included. Why? Because when even though cost model to revaluation model is a change in policy, standard requires prospective adjustment. Why? Understand that. Change in policy could be whenever there is a change in measurement, recognition, presentation, it's a change in policy. To understand whether it's a change in policy or estimate, you need to have this in mind. Okay, not very important area, but there is a weightage that you have to pay there. Ethics and IAS 24 related party transactions. Now, this is again a highly important area because there's going to be one question that's going to focus on ethics. And IAS 24 is going to create ethical implications, and that would be there somewhere in ethical, related question. Okay. So in ethics, you need to know the code of conduct. You need to know the threats. You need to know the safeguards, and there you need to remember there's professional marks here. Okay. What does the code of conduct say? There is objectivity. There is integrity. There is confidentiality. There is professional competence and due care. Then there is professional behavior. This is your code of conduct. The threats are the threats that threaten this code of conduct. What are threats that we have? Self-interest. Knowing this is very important to attempt the ethical questions. Self-review. Then intimidation. Familiarity, advocacy. Right? These are the threats that are going to threaten the codes of conduct. All right. And what are the safeguards you'll be taking to ensure that these threats do not overpower and do not threaten these? That's the structure you need to have. Remember, in the exam, knowledge plus application is what they're looking at. Knowledge, not all the knowledge, but relevant knowledge. Now, if they are identifying only self-interest, self-review threat in the scenario, bringing the knowledge, explaining what is self-interest, what is self-review, then applying it to scenario would get you marks. But if you explain intimidation, familiarity, advocacy when there was no need of it, there you will not be getting marks. That's what you need to understand. Knowledge is also important, but relevant knowledge, right? And then how you apply that knowledge to scenario is very important. Okay, so knowledge is also going to get you marks, and applying that knowledge to scenario is also going to get you more marks. All right, remember that. Then IAS 24 related party transactions, definition, disclosures, government related, how government related parties work, right? Then qualitative type of materiality threshold, how materiality threshold becomes a qualitative type of a related party transaction, and that makes it material, right? And how this can be manipulative and how they can use this to manipulate, right? Then there is a low important area, which is IFRS 8, although new standard. When IFRS 1 is not new standard, this has been something you would have seen at FR level, but not important. It's low importance here. IFRS 8, you need to know the criteria of definition, aggregation, quantitative threshold, again 10% versus 75%, how that works. IAS 34, interim reporting, just theory, knowing that is good enough. And IFRS for SMEs, the characteristics, the omissions, the accounting choices that are disallowed. Then what are simplifications that this standard provides apart from, going against the other usual standards, and what are the advantages and disadvantages, knowing that is sufficient. Then you have IAS 19, okay, very important, new areas. Although this is not examiner's favorite, I wouldn't call examiner's favorite, but very important because these are new standards and very critical standards. Even in September, December 24, we saw this being tested, right? And this can be tested even as a part of consolidation groups, right? And this also has been tested in terms of group, right? So IS 19, you need to know the types of employee benefits. There's post-employment benefit, short-term, termination, other long-term. So post-employment is where there is more focus and there is more depth to that area, right? So when it comes to post-employment, there is defined contribution plan, right? So here you recognize as employment expense in each period. Then there is defined benefit plan contribution, no other liability, only what you're paying, that's it, right? But defined benefit is where there's a fixed liability that you have, for which you have to add more money into the plan. So this is long-term liability at present value, offsetting pension obligations against plan asset is important, right? Then you will be reporting net, right? So it can be a plan deficit if obligation exceeds asset, meaning liability exceeding asset, of course, that makes it a deficit. If it is obligation that does not exceed or asset exceeds the obligation, that becomes a surplus, right? So this becomes a liability, this becomes a asset. Okay. All right. Then okay, now this calculation is very important. When is a liability? Interest, service charge or service cost is added if it's deficit. Okay, deficit given positive number of figures, interest you add, service cost you add, and then contribution to plan asset you have to deduct from here, right? Because you're contributing to plan assets becomes debit, cash becomes credit. So that you deduct from here, and the remeasurement component is going to be the difference between the opening and the closing balance, right? But if it is surplus, if surplus is given in a positive figure, then the interest cost will be deducted. Service cost will be deducted. Contribution will be added. Okay, that you need to remember. If deficit is given in negative number, then interest also will be deducted, service cost will be deducted, and contribution will be added. So this you need to remember clearly, right, to face any sort of IS 19 questions. All right, then how actual calculation is important for the closing figure and how the remeasurement component comes in, which is remeasured through OCI, which cannot be reclassified to SPL. Why? Right? And then components of calculation, net interest component is a part of SPL, service cost component part of SPL, where you will be debiting your SPL, contributions into planned assets, right? Then benefits paid is going to be deducted from both the sides. Then remeasurement component, balancing figure between actuarial calculation year on year and the difference of calculation. So OCI is where it's recorded and not reclassified. Why? Asset ceiling test, what is asset ceiling and how that will be recorded in SFP, which is lower of normal calculation and present value of economic benefits available in terms of refund or reduction in contributions. Understand that. Amendments, curtailments, and settlements, right? So there can be curtailments with settlements as well. So you understand what that is. Then there's IFRS 2. You have equity settled share-based payment versus cash settled share-based payment, right? What is equity settled? What is cash settled? What is vesting date and how performance conditions can be market versus non-market performance conditions? What is share appreciation rights? How that works? Hybrid transactions, what they are? Group share-based payment, right? When it's consolidation aspect of share-based payment, how that works? Employee service being an asset that is consumed simultaneously, which is a justification for violating conceptual framework. What is that? And I've given you some points. Now you try to understand what is that? What does that mean? Why does that happen? Okay? Right. Then there is group accounting. Very important. There are 2 days I had assigned for that. So this is extremely important, right? Question is going to be there from group accounting, right? And say, especially with pre-populated spreadsheet, you will have to know group accounting in and out. All right. So here the standards that they deal with is IFRS 3, IFRS 10, IFRS 11, 12, IAS 27, IAS 28. So IFRS 3, IFRS 10 related areas that you need to focus on: business combination, definition versus concentration test versus elements of business, right? You need to understand what they are. What is concentration test? What is the elements of business? What's the business combination? Then what is the control? How is control defined apart from more than 50%? What else can mean there's control? What else can mean there's no control? Understand that. Acquisition accounting, the contingencies, provisions, internally generated intangibles, goodwill, how you'll have to record those, right? As at the fair value when you acquire. Then goodwill, purchase consideration, cash, SBP, variable. These are new areas. SBP we saw at FRL, but variable is completely new. Contingent, deferred, right? These are going to be the different per level of purchase considerations that you will be dealing with at here, right? It can be cash that you pay to purchase a company. It can be share that you exchange, or variable consideration could be, or it could be contingent consideration, which is dependent on some factor. Then there's deferred consideration, meaning you're paying after a certain period of time where the financing component comes in, right? Then measurement period consideration for provisional amounts. Then this provisional amount, what is the measurement period that they allow, right? Look at that. NCI, fair value method versus net assets method. What happens when it's fair value method? What happens when it's in net assets method? How do you deal with that, right? Then impairment, when it's fair value and it's net asset method, how impairment differs in both of those contexts. Then exemptions from consolidation. What are the valid reasons for exemptions and what are the invalid reasons for exemptions, and what are the special purpose entities and how do you deal with them when you are consolidating? All right. And then there are these standards. Remember the nuances here. Then changes in group structure, where you do mid-year, in terms of acquisition, that it could be mid-year acquisition, step acquisition. So here non-control to control versus control to non-control, right? So non-control can either be under IFRS 9 or IAS 28 associate. If that becomes IFRS 10, what happens? Or if it is between IFRS 10 to IFRS 10, what happens then, right? How the NCI is what it gets impacted in this case. But in this case, everything, right? So you need to remember that. Disposal, step disposal, right? Again, control to control disposal remains within this standard, or from this standard, you either move to IAS 28 or IFRS 9, right? That's control to non-control, right? And when you dispose associate, what happens? What are the rules there? Okay. Then subsidiaries acquired exclusively for resale. How do you deal with them as per IFRS 5? Focus on that. Then there is foreign subsidiaries. How would you be translating those? So IAS 21 in terms of consolidation. Functional currency, exchange differences, OCI that will be reclassified to SPL on disposal. How would that deal? The exchange difference work there. Then functional versus presentation currency criteria, and the mechanics of translation, for example, settled versus unsettled, monetary versus non-monetary, right? So these are the areas that we've even touched upon in FR, so you should know this. Then group statement of cash flow. Right. So here they're not showing the entire thing. Try. Just give me a moment. Anyway, so group statement of cash flow, acquisition versus disposal of subsidiary, net of cash, right? Where there is cash available in subsidiary, how you recognize net of cash in your cash flow statement. Then cash paid to NCI, dividends, overseas cash balances, right? That's important in terms of group. And then you need to know IAS 7's standard criteria. For example, operating, direct versus indirect. So here it's going to be indirect that you need to know. Then investing, financing activities, and the basis of reconciling profit to profit, right? By eliminating the non-cash elements, right? So that you need to focus on. Then you need to remember the workings in the 5 standard workings, the fair value adjustments, right? Then goodwill, non-cash consideration, group retained earnings, right? Then you focus on fair value adjustments, right? So this is how you are going to deal with in your financial statement, SFP and SPL, right? And how you need to be particular about elimination of intragroup transactions, PURP on inventory, PURP on non-current assets, something that you need to look at, loans, receivables, payables, right? Payables, if there is cash or goods in transit, how do you adjust that, right? That's also very important. Then dividends versus interest adjustments, CSPL adjustments in group retained earnings of CSFP. Then you check for disposal adjustments, all right? And then CSPL, what do you do there? CSPL, be particular about full year versus mid-year acquisition. Then you focus on elimination of intra-group transactions, intra-group sales, how you need to remove that, purchases, how you remove that, PURP, how do you adjust that in your cost of sales, profit on NCA, transfer and depreciation adjustment on transfer, right? Loan interest versus dividend income, all these are going to be reflecting in your SPL. How do you adjust those, right? Then you have to take care of CSPL adjustments, the goodwill impairment, the excess depreciation, amortization of fair value adjustment at acquisition. Those are also going to be a part of SPL as well. Then expense the professional fees incurred through acquisition. If you incurred professional fees for acquisition, you have to expense that. Then unwinding interest cost on deferred consideration also is going to be a part of SPL. Then change in contingent consideration. Any change also will be recorded in your SPL. Then you also need to remember the NCI working for profit attribution to parent and NCI, and you need to check for disposal adjustments as well. Okay. And associate, remember equity accounting and focus on signs of significant influence versus control. Now, this is how you are going to present it in your SFP and SPL. Then comes the analysis and interpretation plus IFRS S1, S2, new standards, integrated reporting, and new area. Again, a highly important area. So here, when it comes to analysis and interpretation, there's IAS 33. You need to focus on diluted earnings per share and reflect on its connection with IFRS 9, right? The convertible instruments, what happens, right? Then basis of share options, right? Understand when to use bonus fraction, how it varies in terms of bonus issue and rights issue. TERP comes in terms of the rights issue and bonus issue. To evaluate weighted average number of shares, right? Then you need to know the group SFP, SPL, SCF interpretation. You should be able to interpret the group level statement of financial position, statement of profit or loss, and statement of cash flow. Special attention to intra-group loans, sales and purchases, unrealized profits, synergy, performance as a group versus individual company that you need to focus on. Then cash flow interpretation, negative cash flow in investing activities could be positive, right? The interpretation needs to be positive there. And positive cash flow in financing activities, meaning it's risky. APMs, right? Non-financial performance measures, IFRS S1, S2 integrated reporting. How capitals, 6 capitals work, business model works, and value over time works here. Then when it comes to the current issues, contemporary issues like digital assets, crypto, ICO, security token offerings, natural disasters, climate change, global events, going concern, and IFRS 18 replacing IAS 1 is a current issue that you need to have an idea about. So this is, now these are the specific nuances of the standard that you need to be very clear, very thorough, and very particular about. Is that clear? Is that clear? All right. Right. So there are going to be specific types of questions that we'll have in SBR. So how to approach ethical issues? You work out how many minutes you have to answer the question. Always you start with working out the minutes, right? It's a 100 marks paper. And you are having 3 hours, 180 minutes divided by 100. You have 1.8 minutes per mark. Out of this, 4 marks are professional. So you know how to allocate that within this time frame. And you get 15 minutes of reading time as well. That makes it 195. So you can decide to use this 15 minutes also in answering your questions if you are good at reading, right? So approaching ethical issues, first you work out how many minutes you have to answer the question. Then you read the requirement and analyze it. Then you read the scenario, identify which IFRS standard may be relevant, whether the proposed accounting treatment complies with that IFRS standard. Then identify which fundamental principles from ACCA Code of Ethics are relevant and whether there are any threats to these principles. Objectivity, integrity, confidentiality, professional competence, and due care, professional behavior, right? Are there any threats? Self-interest, could be self-review, could be intimidation, could be familiarity, could be advocacy. Remember that. If there are, you have to bring that knowledge and you have to apply that in the scenario. Prepare an answer plan using keywords from the requirements as headings. Ensure your plan makes use of the information given in the scenario. Application is key. All right, and finally, you complete your answer using keywords from requirements as headings, right? That's what we already saw there. Then there could be financial reporting issues that you have to resolve. How do you do that? First, you work out the number of minutes, then you split it if there is calculation, if there is discursive, you split that accordingly. Then you have to identify sub-requirements. Then you read the scenario, identify relevant IFRS standards and or parts of the conceptual framework and how they should be applied to the scenario. And you plan an answer and you ensure that you cover each of the issues raised in the scenario. Okay? Then complete your answer using separate headings for each item. And then good consolidation techniques. You need to read the scenario, identify exactly what information has been provided and what you need to do with the information. Identify which consolidation workings or adjustment may be required and which IFRS standards or parts of the conceptual framework you may need to explain. Right? Right. Now, this is not important anymore. Right? But identify which consolidation working, adjustment, or correction to error is required. And you are not supposed to perform any detailed calculation. Rather, you're supposed to perform workings. All right. Then there could be interpretation of financial statements. So here you have to read and analyze the requirement, read and analyze the scenario, prepare an answer plan, and you complete your answer by combining knowledge plus application. Structure is key. Then application is key. Now these are going to decide whether you are going to score the professional marks or not. Okay? Right. So that's to do with the basic idea about facing SBR, right? So now we are good to proceed into the paper. Okay. Right. So when it comes to SBR, we have arrived at the practice platform. So in that, we select international ACCA official resources, past exam library, and open September, December 24-25 syllabus. You assign that. And after assigning, now you are supposed to do it on the practice platform. Although I might be using Word and Excel, you do it on the practice platform. Right? The reading time is usually spent on reading all those requirements, all those, information about how to approach the exam. So if you're good at reading, if you've read it enough in your practice platform, you can spend those 15 minutes in planning your answers itself. All right. So we're actually going to do layout, right? That's the question that we are going to start off with, right? Give a thumbs up once I've opened that. After then, let me share the Word file here. All right. So I have actually, I'll be working with right. So I am planning to work on the PDF here. I'll be opening PDF as well. I've actually put the question on the PDF, I mean, on the Word, and I saved it as PDF as well. Okay. There you go. That's the question. Let me open that. Goodness. Right. Okay, so for y'all, this is what you all need to look at. And we're actually using now this is how the pre-populated spreadsheet works here. Okay. This is the pre-populated spreadsheet that they've given here. Okay. So you need to do the workings on the pre-populated spreadsheet. Again, I have taken that in my Excel, so I'll be using Excel for that. Right. But you all need to practice on the practice platform. Please remember that. So I am doing it on Word and Excel so that there is no any interruptions that we may face. There, that is the spreadsheet, pre-populated spreadsheet. All right. Now, this is how the question would look like. Now, what happens here? The question 1 says, Layout Co. is a manufacturing company. It has a financial year end of 31st December 20x7. The following exhibits available on the left-hand side of the screen, but I have all the exhibits down, provide information relevant to the question, right? So exhibit number 1 is Raza provides information about the ownership and board of directors of Raza. Okay, you need to remember IFRS 3, IFRS 10. These are the main standards you need to look at or you need to know. Then there is exhibit number 2, which focuses on pension plan. Provides information about the defined benefit pension plan. There we go. IAS 19. 3, acquisition of Raza Co. sets out the details regarding the acquisition of Raza Co. Right. How the acquisition worked, right? Then you have exhibit 4, which is draft consolidated SOFP, which is this. Right? This is exhibit 4. Okay, so they've given some details. Now, this structure has come into play since 2023 September. What happens here is you will be given a wrong or a draft consolidated statement of financial position or profit or loss that would be incorrect, right? Which you will have to correct, right? You'll have to pass correction entries on this, right? So here you should be very careful about plus and minuses. Remember, there'll be a final revised column, which is not very important. Okay, revise the total of all the adjustments, which is not very important. At exam, don't do that. At exam, you just do the adjustment, finish it, and proceed it. Revised is just going to waste your time. But I will be doing the revised column just to show you how the total looks like. All right. Okay, so let's go back. And this information should be used to answer the question requirement within your chosen response options, right? So this question only is focusing on IFRS 3, IFRS 10, then there's IAS 28 that would be involved here, right? If it is not a group or not, if there's no control, meaning it would either be an associate or IFRS 9. So you need to know all these standards and IAS 19 to answer this question. Okay, so each question is going to focus on multiple different areas and multiple different standards. Okay, right. Exhibit number 1. On 1st of January 20x7, Layout Co. acquired 45% of equity share capital in Raza Co. Okay, 45%. Control. What we, in terms of numbers, what we usually assume as control, anything that's 50% plus. But sometimes 50% plus also cannot be controlled, right? Because there are other criteria that have been outlined in IFRS 3 and IFRS 10. Okay? A private company. On the acquisition of the 45% equity capital, Layout Co. could appoint 5 of Raza Co.'s executive directors and 4 of Raza Co.'s non-executive directors. Okay. Is that a majority? We'll look at that. There are 12 executive directors and 7 non-executive directors, which comprise Brasiocco's board of directors. Okay. 5 out of 12 is not majority. Not majority. Okay. Had it been majority of the board of directors, that can control or that can decide or that can impact the decision of that company, that could be a control scenario. Now, 1, the percentage is low. 2, there is no majority, right? Executive directors who are decision makers, there is no majority in that also. But there is majority where you have 4 out of 7 non-executive directors. Let's see now, NEDs, can they make decisions? Let's read that out. The executive directors make all key business decisions by simple majority. The non-executive directors help in the strategic development of all the company and provide advice to the executive directors, but cannot vote on business decisions. They are just advisory. Non-executive directors are advisory. They cannot impact the decision. They can just advise. They cannot vote. They can't impact the decision. So having a majority there doesn't make sense. No needed. Still, that says that there is no control. Okay, there is no majority. You cannot decide. You cannot vote on a decision of yours because you do not have majority. Yes, your 5 of them can vote, but 5 is not the majority. 6 out of 12 also makes it half. Had it been 7, yes, there is majority, but this is not majority. Okay, again, another indication that says there's no control, meaning this is not a subsidiary. Okay. The directors appointed by Layout Co always vote in line with Layout Co's policies. Okay, doesn't matter, but still they're not majority. They can't impact the decisions, right? Okay, now 45%. Okay, now when it is 45%, if the other remaining is dispersed among multiple unrelated shareholders, could be thousands, millions of unrelated shareholders, small portion, they can't make decision, they're not even interested. Then yes, that also can become a part of control. But is that the case? Let's read. The other 55% of the shares are owned by a single private investor who can appoint the remaining 7 executive directors and 3 non-executive directors who can appoint single, no dispersed, 55% owned by single, meaning that person has the control, not 45%. Where 55% can appoint 7 executive directors, majority is appointed by that person, so that person has the control, not you. Okay, that also clarifies that there is no control. Okay, during the year ended 31st December 2007, Layout Co entered into a forward contract. 31st December. When is the year end? 31st December. Forward contract to purchase an additional 10% of the equity capital of Brasiocco in October 2008. October 2008. When exercised, this will not change the number of directors which Layout Co can appoint. Okay. Had there been a possible increase in number of shareholders, no, number of shares, right? Now 45 plus 10 would make it 55. That could be controlled had it been within the year. Now, what's the question? What's the question? Requirements. We need to read the requirements here. What's the requirements? Using Exhibit 1 and in accordance with IFRS 10, explain why Layout Co does not control. Okay. Now, they've made it easy. Right? They've told it does not control. Now, you have to prove that it does not control. Right? Examiners are being very, giving. Right? So remember, if the examiners are saying, if the question is saying that Layout does not control, you don't go and prove that it controls. Anyway, when we're discussing, we saw it does not control. Now they've told it does not control, so you need to be very clear about that. Now you have to prove why it does not control. Okay, knowledge plus application comes into play here. Okay, right. At the 31st December. Now, that's October 28th where you'll be exercising. So that's beyond the year. But at this point, 31st December, that's not exercise. You don't even know whether that will be exercised or not, whether that's going to be positive at that point or not to exercise. Right? So, doesn't matter. Had it been October 28th, maybe yes. Now they own 55%. But On top of that, there's another line that says, when exercised, this will not change the number of directors which layout co can appoint. Still, layout can't appoint majority of directors. Majority of directors is required to make majority of the decisions. Even after 55%, layout co cannot appoint majority. So even when they exercise it in October 2027 also, they can't. That's not control. Why? There is no majority. Okay? Meaning those are the points that you can bring in to prove that there is no control. Okay? Those are the points that you can bring that there is to prove that there is no control, right? So when you're answering this first requirement, when you're answering that first requirement, I'm not going to bring out all the theory. I'm sure you know the theory. First, you bring the control definition. Three conditions. Knowledge. This is the knowledge part. Okay. Now, three conditions. Now, control goes beyond that also, right? Now, that's the basic definition where there are three conditions, right? But control can go beyond that, where we have all the other aspects coming in. If there is a future exercising right, or the majority, the decision-making impact, the board of directors, all those conditions coming as additional conditions, right? That's also knowledge that you can bring here, right? So first you bring the control definition. Then you say that first point, 45% less than 50%, right? Then you say, even if it's less than 50%, we have to look at the detailed control requirements, which is board of directors appointment, majority. Then decision making. Can they? Right? Future exercisable right. Impacts or not. Right? And then, so these are the good, how many marks do we have for that requirement? 8 marks. There's 8 marks here, right? So 8 marks. This would give you one mark. All right. Here, knowledge would give you 1 mark. Application will give you 1 mark. Knowledge 1 mark, application 1 mark. Knowledge 1 mark, application 1 mark. Knowledge 1 mark, application 1 mark. Sometimes when your application is strong, they can give you more than 1 marks also, right? Future exercisable right, does that impact or not? Conclusion. Okay. So you have to bring this first point, 45% is what they own, which is less than 50%, which indicates that they own lesser than the required shares to have a control, but control scenario looks at detailed control requirements to identify whether they have control or not. The first one about board appointment, BOD appointment, whether they can appoint majority of the board of directors, which this company cannot. Right? Because they can appoint only 5 out of 12, while the majority is 7 out of 12. Therefore, no. Yes, before conclusion, we missed 1 point. Right? We missed 1 point. What was the point that we missed? Remaining shares dispersed or single. If it's dispersed, yes, still you can tell if there is control. But here it is single. Who is controlling? Who can appoint majority? who can do all the decision making. Therefore, that's also one more point that you can add in. How many points do we have? 5 points. 5 applications. So we have 5, 10, 11. Conclusion. Give you 1 point. Now remember, the requirement says 8 points, 8 marks. That's the maximum marks you can gather. Now let's say you've screwed up in one area. Still, there is how many marks that we can get here? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. 12 marks is allowed. So even if you screw up, still there is chance that you can get full 8 marks if you focus on more points or more marks, right? One well-explained point gives you marks. So remember, even if you feel like you would have gone wrong somewhere, still there's a chance that you can get full marks for that requirement. Okay? It all depends on how you are applying the knowledge that you have. Board of directors, no majority. Decision making, they can't, because all the non-independent is majority, non-independent are advisory. They are not majority. Although they are majority, they can't make decisions. They can't vote. So that does not make a difference, right? Decision making is with executive directors, of which they can apply only minority. Then future exercisable right. Yes, they have future exercisable right of 10%, which is happening on next year, October 2028, which is beyond the year. But even after that, there'll be no board appointment possibility. Only if they can appoint 7, they can control. Right? Which is why it is clear that there is no control. Right? Then you give the conclusion by reiterating this, saying that therefore, in accordance with IFRS 10, consolidated financial statements layout code does not control Brazil Co as at 31st December 20x7. Okay. Is that clear? Right? Okay. Then the exhibit 2. Now, if it is not control, and if they've assumed it's control, then it's problem, right? Okay, if you read exhibit 3, we'll understand. That's where the acquisition, we'll understand what they've done with that. Using exhibit 2, explain with appropriate calculation how the defined benefit plan should be accounted for in the year end 31st December 2027, IAS 19. Let's go to exhibit 2. At 1st January 2027, the defined benefit pension plan of Layout Co had a net deficit. So they are saying net deficit meaning obligation exceeds the asset. That's 24 million. Okay, 24 million. The actuary has provided the following information for the year ended 31st December 2027. Current service cost 6 million. Cash contributions 4 million. Net deficit as of 31st December 2027, 32 million. At 1st January 2027, the interest rate on high quality corporate bonds was 5%. 5% was the interest rate, right? 5%. On 31st December 2027, the pension plan extinguished its obligation to 250 ex-employees by paying 60 million out of its plan assets to another pension provider. Extinguished meaning fired the employees, right? Pension plan extinguished, they fired the employees, they terminated the employees. Now, it was not just termination, right? When there's termination, that's known as curtailment. But it's not just curtailment. What I'm saying is to another pension provider, meaning curtailment with settlement. Curtailment with settlement. All right. So this reduced the present value of plan obligation by 50 million. Plan obligation went down by 50 million. Plan asset went down by 60 million. So there is, what's the double entry? Debit, plan obligation, which is a liability because liability is going off, 50. Credit asset, plan asset is going up, 60. Then there is debit, loss, right? There's 10 million loss. Okay, so that 10 million loss will be considered as a past service cost. It is going to be added here. Component of past service cost. Okay. Why? Usually, what do? We have defined benefit obligation, then defined plan asset, right? Net, right? So here, what do? DBO is going down, plan asset is going down by 60. So of course, minus 50 plus minus 60 becomes net deficit plus 10. Okay, right. After the above events, actually valued the net deficit at 40 million. That's a closing actuary calculation. Now that would rise to your remeasurement component. The only accounting entry in respect of this pension plan, now there's another problem. The only accounting entry in respect of this pension plan was to recognize the cash contributions as an expense in statement of profit or loss. Cash contributions to plan asset as expense. Wrong double entry, right? What they've done? Debit expense 4. Credit cash 4. What should be the correct double entry? Debit plan asset. Your plan asset is increasing, not expense. That's wrong. And credit cash. So when your plan asset increases, your obligation goes down, right? So that's something you need to remember. Okay. So there's a format here, right? Now here again in this question also, knowledge plus application. This requires calculation plus discussion. So you have to calculate how there's curtailment with settlement, how that gives rise to that gives rise to past service cost. What is past service cost? What is actual calculation? What does IAS 19 say about post termination benefit? So you start with IAS 19. Standard requirements. Then you discuss about all the points that were there. So we had service cost. We had interest, which is 5% into 24 million that we saw as opening, right? Then discuss that also, and then you calculate. Then there was cash contribution and how the error was a problem, kind of contribution, error. You discuss about that error also, right? Then you tell what is going to be the correction. How do you correct? So these are all explanation, okay? These are all explanations. So how are you going to correct that error, the correction, right? And on top of that, how there'll be what is remeasurement component and how much is it? You do the calculation, which is going to be the balancing figure, and how this will not, this is through OCI, not reclassified. So you see how many points we have gathered already for the explanation, right? Not reclassified. Then you provide the calculation of the complete picture. You provide that table. Okay. So what I'm going to explain, IAS 19 standard requirements, you say what is the employee benefits and how post-employment benefit works. Then you talk about the interest that's given here, the service, you discuss that service cost, how there's present, but there's past service cost that happens because of curtailment with settlement, right? Service cost, you touch upon curtailment with settlement, right? What is curtailment with settlement and how it gives rise to past service cost, right? What happens? Your obligation goes down by 50, planned asset goes down by 10. There is a loss on settlement, which becomes past service cost. Then the interest component, how 5% of 24 will be your interest for that year. Then cash contribution, the error that they've made on cash contribution. It's not supposed to be expense, it's supposed to be asset. How do you correct that error? You explain that entire thing. Then you talk about remeasurement component, which is going to be the balancing figure between the difference of actuarial figure and whatever we've calculated. And that's going to be recorded through other comprehensive income, which will not be reclassified at the point of sale, right? Then you do the calculation. Net deficit is what they've given. 24 million. It's net deficit. So meaning interest added, service cost added, cash contributions deducted. We already discussed that when we were discussing the study planning, right? Plus interest, which is 5% into 24 million. How much is that? 5% into 24 million is 1.2 million. Add 1.2 million. Then there is plus service cost, which is, now when it comes to the past service cost, you do the calculation when you're explaining this part. Huh? This part is where you do that calculation that we discussed. You know how debit your obligation, all the double entries you show at the discussion level, right? Service cost, past service cost, they have, what is the past service cost that they had given? Exhibit 2. 6 plus 10. The current is 6 and current plus past. So current is 6 plus 10. So that is 16 million. Okay. Then contributions, which is supposed to be positive planned asset, meaning negative liability, reduces the liability, right? So deficit goes down. Cash contribution, correct that, 4 million. Then the closing, the net deficit as at 31st of December X7, 40 million. They've given that figure. Now quickly see what will be the remeasurement component in that case. That's going to be the balancing figure. Remeasurement component is going to be the balancing figure. So let's quickly do the math. So 24, 20, 25. So and 4, 1.2, 16. That is 37.2. This total is 37.2. Okay. 37.2 is the total here. Right. 37.2 is the total here. 37.2 and 40 million. What's the difference? The difference is 2.8 million. That's your remeasurement component. This goes into through your OCI. Service cost, SPL, SPL. Right? And 40 million is going to be in your SFP. So you just give an explanation of the presentation also. Okay. So this is how your defined benefit or employee benefits would work. Right? And this adjustment you'll be making when you do the pre-populated spreadsheet. Right? So that's exhibit number 2. So we're done with 2 exhibits. Then comes exhibit number 3. On 1st January 2027, Layout Co. acquired 45%, we know that, of the 10 million $1 equity shares of Brazil Co. This gave Layout Co. significant influence over Brazil Co. Significant influence, meaning an associate. However, the investment was incorrectly classified as a subsidiary and accounted for using the acquisition method in consolidated financial statements. There is an incorrect thing that they have done. Now you need to know that they would have calculated goodwill, NCI, then no associate recorded. So these are the errors that they've done. Huh? No associate, then the intra-group adjustment would have happened. Right? When it's controlled, these are the adjustments that would have happened. Okay? Then the fair value adjustments also. Fair value adjustments. Right? Which would lead to excess depreciation. Now that's knowledge that you should be knowing. Right? When they say that they've done this, means they would have done all this. Now we need to eliminate that. Now, to eliminate that is not easy. Why? Because you have to first calculate what would be the goodwill, then you'll be able to eliminate that. Okay? Right. When calculating goodwill, the non-controlling interest was measured at fair value of 51 million, and the fair value of the identifiable net assets acquired was 83 million. The purchase consideration comprised cash of $35 million. Right. On 1st January, Raza opening retail earnings was 39 million. Why that's required? To understand the difference between opening and closing retail earnings, know the post-acquisition profits. And other components of equity of 3 million. Right? 3 million was the other component of equity. The difference between fair value of net assets and the carrying amount in the individual financial statements was attributable to property, plant, and equipment. Right. Now you need to know the difference between the net assets and the carrying amount of individual in financial statements is attributed to property, plant, and equipment. So you should be able to figure that amount out. Okay. With the remaining useful life of 5 years. So 5 years meaning you know what would be the excess depreciation. Then they've given the individual financial statements. Right. Using exhibits 2 and 3, meaning you are supposed to use exhibit 2 as well, the defined benefit plan. Right? The pre-populated spreadsheet response option to correct the draft consolidated statement of financial position as of 31st December 2027 for the following facts. Raza Co is an associate and not a subsidiary. Defined benefit pension plan has not been correctly accounted for. Right. Now, who does the defined benefit plan? Layout parent. So no adjustment to subsidiary, so only adjustment to parent, so you will not have to eliminate that. That you'll have to keep. You'll have to show, but let's just do the corrections. Right. Now let's proceed into the pre-populated spreadsheet. All right. This is the pre-populated spreadsheet. Okay. Right. But before we get into that, quickly try to absorb what we've done so far. Just absorb this. All right, so we'll be resuming back in 10 minutes. All right. All right. So let's proceed to the pre-populated spreadsheet. All right. Let's see who is here now. Okay. Right. So first we need to know what was goodwill, how much was goodwill rather. Right. Okay, how do we calculate goodwill? We need to know the calculations, basic knowledge that you need to carry forward. We have consideration. How much a consideration they are saying here? The exhibit, they gave the consideration. 35 million. Okay. 35 million. So let's do work in millions. All right. Then the NCI acquisition. How much is the NCI acquisition? NCI was measured at fair value of 51 million. NCI 51 million. Right. And then fair value of net assets at acquisition. How much was that? Fair value of identifiable net assets was 83 million. Fair value of net assets, 83 million. So that will be deducting. And we arrive at goodwill. Right? So goodwill is 3 million. Right? Goodwill is 3 million. So they've recorded a goodwill of 3 million. Let's make all the adjustments. Or let's make the adjustments as we proceed. Right? That would be easier. Right? So first we have to remove the subsidiary here. Remove subsidiary. Right. So goodwill of 3 million, we remove that first. We've identified how much is the goodwill. So we remove the goodwill of 3 million. Okay. Right. Now let's go back to our working. Then we have the fair value uplift, fair value adjustment. If you read further, we can see the difference between fair value of net assets and the carrying amount in the individual financial statement is attributable to property, plant, and equipment with a remaining useful life of 5 years at the acquisition date. Right. Working to PPE. Fair value adjustment. Right. What was the PPE figure? What was the PPE figure as per statement of financial position, individual financial statement? 32. Right? As per SFP was 32. Okay? And then what is the uplift? How do we know the uplift? Uplift is going to be the difference between the net identifiable net assets, which is 83 million, minus the other components of equity. Right? So net assets. We do another working here. Still working 3. Net assets. Okay. Share capital remains the same in the individual financial statement. There's no adjustment there. Since they've done subsidiary adjustment, share capital will be remaining the same. 10. Then other component of equity also will remain the same. 3. There's no changes there. Only change we'll see will be in retained earnings. So we have to get the retained earnings pre-acquisition. Right? How much is that? They've given it here. On 1st January, Brazioco had retained earnings of 39 million. 39, right? And then identifiable net assets total. Identifiable net asset is 83. So we know that the difference is going to be the fair value uplift. How much the total here? This plus this plus this. So fair value adjustment going to be 83 minus 52. So that's 31 million. So fair value adjustment is 31 million. Now, when there is a fair value adjustment, there will be excess depreciation as well. How much is going to be the excess depreciation? Fair value, excess fair value, meaning fair value adjustment, divided by useful life remaining, which is 5 years. That's what they're saying here. Remaining useful life of 5 years. So 31 divided by 5 is our excess depreciation. Okay, that's the excess depreciation. So property, plant, and equipment total would be how much? Plus this minus excess depreciation. So we'll make it minus 6.2. That's 56.8. Now we have to eliminate this 56.8 from our subsidiary. From here we minus 56.8. Be very careful with plus and minuses. Investment in associates, we will be adding the investment. What's the investment in associates? That is a part of subsidiary removal. When you remove subsidiary, the investment, the consideration paid will be already the investment in associates. That is 35 million. It is given here, 35 million, that we take it at the face value there. Current assets, this includes the current assets of the subsidiary. Current is 47, so we deduct the 47 million as well. Right, so there we remove by deducting 47 million. And then we also would have the retained earnings, right? Retained earnings. Now we do the next working for retained earnings calculation. Okay, right. So retained earning at reporting date, how much was retained earning at reporting date? Consolidated retained earning at reporting date. Retained earning at reporting date was right. So retained earning they've given here is 55. Okay, at reporting date was 55. Post acquisition retained earnings. Okay, let's go back. So retained earning at acquisition was retained earning at acquisition was 39 million. Okay, that was the retained earning at acquisition. Right. So retained earnings at acquisition, when we look at that, always remember, now, although we did not do a complete working at the pre-acquisition stage, we know at acquisition and post-acquisition, the 55 retained earnings that is given here, 55 retained earnings, which is given here, there would have been the excess depreciation adjustment, right? What happens? The identifiable asset, what do? We have the retained earnings, right? The closing retained earnings is where the excess depreciation should have been done, right? Expense. So that brings your retained earnings down. So retained earnings at acquisition is what we have, and retained earning at reporting date. Reporting date will be 55, we know it was there, minus we deduct the excess depreciation, and our retained earning at reporting date is 48.8 million. Okay. So what is the post acquisition? Post acquisition is 9.8. Now 9.8 is not parents alone. What is parent? Now we have to split it among parent and NCI. Parent was 45%, NCI was 55%. Okay. So this into this is our parents' retained earnings, attributed parents, and this into is subsidiary, NCIs. Okay, that is NCI's retained earnings. Now we will have to remove the retained earnings also from removing the subsidiaries. Right? When we're removing subsidiary, we'll be removing the retained earning as well. 4 point. Okay, the parent component only, and the current liabilities. Let's go back to the individual financial statements. There's a current liability of 11, so we remove that also. Right, that 11 is also removed here. Clear? So that also we remove. And then the next item that we have done, which we have to remove, is going to be working 4. We've done working 3, so working 4, which is NCI. At acquisition, how much was the NCI? At acquisition, NCI was 51. Retained earning attributable to NCI, post acquisition retained earning. Post acquisition 5.39. So NCI at reporting date was this plus 56.39 that we remove from non-controlling interest. And with that, we have eliminated the NCI completely. Subsidiary has been eliminated now. Okay, subsidiary elimination done. Then we have to make another adjustment, which is going to be associate profits. Now, these are associate profits. Retained earnings removed as a subsidized profit will be associates profits. So we have to consider that 4.4 million as associates profits, which will be added in a retained earning component, as well as investment in associate will be the investment, the initial investment plus the post acquisition profits of the associate. 0.4. Right, 4.4. Clear? So here we have adjusted associate profit as well. This is done. Exhibit 1 done. Exhibit 3 done. Right, now we are moving to exhibit 2. Exhibit 2, we have already done that working here. We've already done the working of exhibit 2 here. So we exactly know what is going to be the deficit. Deficit is going to be 40 million. We know that, right? Deficit is going to be 40 million. Okay. So pension or defined benefit. obligation. Right, defined benefit obligation is going to be net defined benefit deficit is going to be 40 million. That we know. We know it's 40 million. But how the adjustment would happen, that also we know, right? We know what the adjustments are. So adjustments are going to be on other components of equity as well as retained earning. Other component of equity, how much? 2.8 remeasurement component, right? 2.8 of remeasurement component. Cost, net deficit, we're adding there. So it's a cost, we deduct, right? Debit the other components of equity, right? Because we are recording it through other comprehensive income. Okay. Then retained earning adjustments. The service cost, the interest cost will be deducted. It's a cost on your SPL. It's an expense. So you deduct that from your retained earnings. And your contributions, which they have expense, you have to add that back also. Right? So what are the figures? We had minus 16 plus we had minus 1.2 plus 4. Okay. So retained earnings. We'll do a separate working here. So that's clear. That makes things clearer. Working 5, define benefit obligation. Right? Opening net deficit was 24 million. Interest expense was 1.2 million, which was this into 5%. Then the service cost, I'm just bringing the what we wrote into table here, was 10 plus 6, which is 16. Then cash contribution was minus 4. Net deficit as at 31st December X7 actuarial calculation was 40. So we know the remeasurement component was added to net deficit of 2.8. That's what made it 40. Okay. Now this is going to deduct our retained earnings, and plus our retained earnings. Okay. This is going to credit the retained earnings, debit the retained earnings, debit, credit. Right. And then this is going to debit our OCI. Okay. Now we know the retained earning figure that we're taking is minus 13.2. Minus 13.2. Okay. Minus 13.2. Right. So here they've already given net defined benefit deficit 24. So it becomes 40 at the end. So we know the difference will be 40 minus 24. That's 16. Okay. Right. So that's in one line. Or if you want, you can even break it down. How do you break it down? You can show your pension interest separately. Then you can show pension service cost separately. Then you can show pension contribution separately. Then you can show remeasurement component separately. You can show it separately. How do you show it separately? Pension interest, you are going to adjust the retained earnings by 1.2 minus 1.2. Then you are going to adjust the net defined benefit deficit by adding 1.2 there. So I'm just showing how we do it separately also. So let me just take these off. Okay, so this is the second way that I'm showing to you. Pension service costs, retained earnings, you deduct from retained earnings, and then you add here obligation or liability. Then contribution, cash contribution, they have deducted, so you add that back and you deduct from here. Okay. And then other comprehensive income, other components of equity, deduct 2.8. This would be added. Okay. This is how it happens here. All right. So that's how we show separately. Or if you want, you can show it single line also. Whatever you feel is the best. And show it as a working out. If you've already done it for while explaining the exhibit 2, where answering the second question, so second requirement, then you don't need to show it here. You can use the figures from there itself. Okay, right. Then come the final. This is not necessary to you, but I am doing it just to show that it balances. This plus this. Let's see if it balances. This is a new non-current asset, right? Then a total current asset, total current, these are total non-current, 745.6. Then a total current asset is, there's an adjustment there also where we have removed the subsidized current asset because when we are consolidating, we would have added that. So now our total assets are non-current asset plus current asset, 2154, right? Share capital remains the same. There is an adjustment here, this plus this. Let's see if it balances. Then there is an adjustment here. NCI is removed. Total equity is this plus this plus this plus this. Total equity. Total liabilities is a non-current liability. 40. We remove the current liabilities because we are eliminating subsidiary. We would have consolidated that. This is our total equity plus liabilities. There we go. It balances 2154.6 to 2154.6. Okay. So this is how we make the adjustments. So be very careful with pluses and minuses when you are adjusting pre-populated spreadsheet. Okay. So this is how you answer this question. All right. So there is discussion plus there is calculation. Yeah. And with that, we conclude question 1. Then we have question 2, which focuses on Apani Waco, the parent company, the financial year of 31st December. Exhibits about statement of cash flows describe the treatment of some transaction in consolidated statement of cash flows. So they're talking about consolidated statement of cash flows. Important again. Then second exhibit about ethical issues. Describes ethical issues facing Mr. Lennox, one of the accountants of the Apaniva group. So I would like you all to attempt this question. All right. So we'll discuss this next week, maybe. Right. Or let's see if we'll discuss the pre-March mocks question 1, question 2 as time permits. All right. So using exhibit 1, discuss the correct presentation of following issues in consolidated statement of cash flows. Discuss the correct presentation. B, using exhibit 2, discuss the ethical issues and the actions which Mr. Lennox should take to address these. There are professional marks. So that's question 2. Okay. All right. So that's question 2. So we'll take this question up maybe on next week. And we'll try to see how much of pre-mock that we can do. So all the very best with your SBR exams. Please attempt all the past papers, just like the plan that we saw here. Try to implement that, do as many past papers as possible. If you are able to do that, you definitely will be able to ace your exams. All right. So with that, I'll see you all on next week. Until then, stay safe, take care, have a great week ahead, have a great study session ahead, and all the very best with your SBR exams.